Hello everyone. Today we are going to deal with the second part of the first chapter of the economic survey, that is economic outlook, prospects and policy challenges. So the economic survey first chapter has the topic global context. In the global context, it says like this: since the economic survey and budget was presented last year, the Indian economy has continued to consolidate the gains achieved in restoring macroeconomic stability. That is, it is essentially saying that inflation, fiscal deficit and current account deficit have all declined, and thus making the Indian economy strong macroeconomically. And economic growth is at varying speeds in different sectors. In some it's high, in some it's low. So as we know that the external global environment is weak, very many economies are not growing at a very high pace, and India is the leader in the growth. China has also slowed down. There are also problems in oil exporting countries as well as Brazil. So it is unusually challenging and weak environment. So major financial crises seem to be occurring frequently even in the past, but now it has started occurring more frequently. Like if we see previously, Latin American crisis had happened in 1982, Asian financial crisis happened in late 1990s, and then Eastern European crisis of 2008. These three crises happened at the interval of 10 years. Okay. But now we see the rapid succession of crises. See, the global financial crisis happened in 2008, then the European crisis have been prolonged due to its problems, which has extended to the European Union, then mini crisis of 2013 I will just talk about, and then China provoked turbulence last year, which led to variation of the the stock markets as well as the currency rates. So in these we see there is 2 or 3 years difference. So this means that the crisis has started to happen in a relatively shorter time period, and this can be continued later also, because we see weakness in other economies too, like China, Brazil and Saudi Arabia. They are vulnerable to future crises. Supposedly China, because exports have weakened. So China was export-led economy. Its exports decided its growth. So exports are weakened due to weak global demand. Hence, China is not able to maintain its high growth rate, and its corporates, which have taken a lot of debt from its banks, are not able to, or may not be able to pay them in future. Similarly in Brazil, which is export dependent. Similarly in Saudi Arabia, which is petroleum dependent, which exports crude oil to earn its revenue. So these are, and crude oil's demand is very less due to less global demand, also due to shale gas discovery also, and as these petroleum exporting nations are not deciding to cut the production. So these are some of the cartoons shown. First cartoon is based on the Latin American crisis in 1982. In this crisis, the countries or the West gave the Latin American governments huge debts, and many other countries gave the debt earned by petrodollars. Okay, so this debt was spent by Latin American countries recklessly. We will just deal with it. And this example is of Asian financial crisis. See, all the currencies of Thailand, Korea, Indonesia, Philippines, Malaysia, Taiwan plummeted. You are seeing a fall in the currencies. So this is making a joke of IM. F means I am fired. That is, people got fired because of IMF. So this gives a short description of various kinds of crises that have happened in the recent 30 or 40 years. So since the 1980s, external financial crises have followed one of the three basic forms. First can be said to be a Latin American type of crisis, the other can be said to be a Asian financial crisis, and the third one can be said to be a global financial crisis. So the most of the crisis or implications, so the most of the crises fit in between these three kinds of crises, and what will happen next might be very different from the crises that have happened till now, and that implications of that would be unlike anything that we have seen in 80 years. So supposingly in the Latin American debt crisis, governments went on a spending spree, like they were spending a lot as they were financed by the foreign borrowing, and they also pegged their exchange rate. Pegging means they had the fixed exchange rate with respect to some other currency. Suppose they have pegged their currency with the dollar. So dollar side, suppose it decided in $1 we will keep it as 40 rupees, suppose if we are talking about India. So as dollars price varies, they will also change their currency respectively in correspondence with the dollar. So due to this, the spending led to a classic economic overheating. Overheating means more and more money was being supplied. People, the factories or the corporates starting producing more and more, and because of more money supply, there was more inflation also, and people started spending less. So there were large current account deficits, and thus these current account deficit was eventually proved difficult to finance, and this led to the defaults. And also when the people are not buying, so the corporates who have taken a lot of loans from the government or the banks, they will not be able to pay their debts. So there is also corporate crisis. So this is the Latin American type. In the Asian financial type crisis of 1997 type, so in this crisis what happened is the government is replaced by external corporates or private corporates. So these troubles happened because of private, not government. In the Latin American it was government, here it was due to private. Okay. And the third one is the global financial crisis. What happened in the global financial crisis? Global financial crisis, America was the systemically important country which was affected. Here it was due to subprime loans. Subprime loans means the banks didn't verify that the borrower be able to pay the money, and the mortgages they have taken. Mortgages means some kind of security when they advance a loan to somebody. So the mortgages rate fell. Suppose in the case of housing loans, whatever mortgages they have given, or some property or some land they have pledged, the prices fell even below the loan amount that they given. So this led to the speculation, as well as people. It was also said that people bought a credit card to pay the bill of their other credit cards. So this kind of things happened in the global financial crisis, and its repercussions we are still facing. And in response to this global financial crisis only, the Federal Reserve Bank, which is the central bank of the USA, it started quantitative easing. Quantitative easing means they started putting more and more money into the economy. Okay, that is, they started buying bonds. So they will pay the money, more money will go to the economy when they buy bonds of various banks. Okay, you are seeing assets, you are seeing in the global financial asset price bubble in housing. What do you mean by bubble? Bubble means when the expectation in the future rise, people put more and more money into it. So the rise is not sustainable. Everybody knows that it is going to fall at some time. So when it reaches a peak, it falls and everything collapses like a pack of cards. And this leads to closing of many companies and all. Suppose it happened in housing. Similarly, it happened in dot-com bubble when the IT was at boom. So people invested more and more money, which were unsustainable, and it led to the crash. So this is the main crux of the things, and rest of the things you can see in this table. Now something we need to talk about the future economic crisis that can happen. This can happen in China. I've already told you China's current situation is similar to the Asian financial crisis situation, in which there are fears about the excessive corporate debt in the context of slowing growth and changing economic management, which is fostering very large capital outflows. Like money by the foreign companies have been taken out from China. But in this context, or in the context of China, there is less assumption that it can be similar to the previous kind of crisis, because China has huge foreign exchange reserves of $3 trillion, which is at least you can say it is 10 times of India's foreign exchange reserves. So it can pump in money, and it can correct the companies, or it can help the companies and banks. So it has more time to adjust due to its huge foreign exchange reserve. Okay. So let's move ahead. Now, when we talk about the Indian context, Indian economy has continued to consolidate the gains achieved in restoring macroeconomic stability. Okay, so for finding out the macroeconomic stability, last year the economic survey had constructed a index of macroeconomic vulnerability. As I have written here, index of macroeconomic vulnerability. So it is nothing else, it is just the addition of inflation plus fiscal deficit plus current account deficit. Inflation everybody knows, it is a general increase in the average price level, and fiscal deficit is net commercial borrowings of the government, net commercial borrowings. Okay, and current account deficit is when imports are greater than exports. So on these three counts, India has done very well, but in 2012, India was most vulnerable of the major emerging market economies. Subsequently, India has made many dramatic strides in reducing its macroeconomic vulnerability. Since 2013, its index has improved by 5.3 percentage points as compared to only 0.7% of China. See here, approximately this is 5.7 percentage points improvement when you see the period of 2013 to 2016, but China has only gained how much? Only 0.7%. What I mean by it is that China is more macroeconomically vulnerable than India. So in the last year's survey, they also constructed a simple index called Rational Investors Rating Index. Are you able to see? Rational Investor Ratings Index. And what is this index is? It combines the growth as well as the macroeconomic vulnerability index. Okay, growth means it gives rewards. If it has growth, it gives positive. If it has vulnerability, it is tagged as risk. So RI or Rational Investors Rating Index is depicted below, as you can see, for the period of 2012 to 16. You can say because growth is more and our macroeconomic vulnerability is less, you can see a peak in India's performance, right? but China you will see a fall. Okay, but China, because of huge growth for 30 years or so, are above us. This gap is there. Okay, so let's move ahead. Now inflation and WPI and CPI. CPI is consumer price index, WPI is wholesale price index. Consumer price index includes taxes, WPI is at the factory level or wholesale level. Okay, so CPI has remained in the range of 5.5%. Okay, for long time, sorry, it has remained 5.5%, but WPI has been in the negative territory. Okay, it is negative territory since November 2014. See, are you able to see here? This is CPI headline. By the way, what is the difference between core and headline inflation? Core inflation is total commodities value or inflation minus energy and food commodities. That is all the commodities except energy and food. Okay, so core inflation, core headline, CPI headline inflation, or any kind of CPI core inflation, or rural wages also, as well as WPI headline. These all kinds of indexes have seen a fall, and especially WPI headline you will see is it has gone below the negative territory in November 2014. I have already told you just now. Also, we see our gold imports. Are you able to see in the second diagram? The gold imports have stabilized now. Previously, you can see it was fluctuating a lot. It was a huge bump in 2013. So then we had to impose the controls, import control, that only this much can be imported, or 80-20 scheme was there. Out of total, 20% need to be exported, all because of this import control. And again, then after some time it started increasing, the demand started increasing. So why imposed import control? Because there was CAD problem. CAD problem is if dollars were not there to pay for petroleum, because it is just for makeup or jewelry is just for show. It has no real useful purpose. Then in the December 2014, we again imposed the controls. Now because the petroleum rate is very low, so we don't have much problem even if the demand is increased of gold. Okay, so let's move ahead. Before that, the core inflation as well as the headline inflation is low because the underlying trends, that is of rural wage as well as minimum support price that we give to farmers, have not increased much by the government. So let's move ahead. External position of India. Now it is very important. The current account deficit has declined. That is, what do you mean by that? That we are becoming more robust externally. Current account deficit has declined means we have more dollars to pay for our imports. Similarly, foreign exchange reserves have risen. That is, we are exporting more, or we are getting more dollars. Maybe exporting more, maybe we are getting more foreign currency, like net FDI inflows have grown from $21.9 billion to $27.7 billion in 2014-15 to 2015-16. Also, we see the nominal value of the rupee measured against the basket of currencies have been steady. Okay, it is falling against the dollar, but it has risen against the pound, the yen, franc. Okay, so it has been steady. Now before coming to the next slide, I want to tell you about the fiscal sector, which has registered the three striking successes. First of all, it has led to fiscal consolidation by the government. Like the target for the next year is 3.5% of GDP, and this year is 3.9% of GDP. When I talk about year, I talk about the financial year, that is April to the March of next year. Okay. So the three striking successes, first one is fiscal consolidation, second one is improvement in indirect tax collection efficiency, and the third one is improvement in quality of spending at all levels of government, that is wasteful expenditure is being prevented. Also we have seen is the rise in the indirect as well as direct taxes in the 9 or 10 months that have passed before the release of this economic survey, or whatever data was available. It was for 9 months. In that we have seen increase in the direct as well as indirect tax. So quality of general government spending we are talking about. We see here it is written that there is a significant increase in the aggregate capital infrastructure. What do you mean by capital infrastructure? Capital infrastructure means capital goods or physical assets like property, industrial buildings or equipment, which is used to undertake new project investments by the firm. So this aggregate capital expenditure, that is of all the firms in the Indian economy, have seen a spending increase of 0.6% of the GDP, which is a very good news, as we are installing machines which will help in making more and more products. That is, you can say it is helping in Make in India. Okay, that is, we are giving boost to the manufacturing sector. Now the increase in the capital expenditure have occurred both at the level of the center as well as at the level of the states. But center has contributed to the 42% and states have contributed to the 46% of the share. Now we are taking a general government expenditure because in the 14th Finance Commission, 42% of the total tax pool that has to be divided has been given to the states. So both have contributed in increasing the aggregate capital expenditure. Now general government expenditure according to the economic survey has witnessed an uptick in the three major social sectors, that is education, health and agriculture and R&D in that. And you see here, when we see it is a percentage of GDP, education sector has taken a 0.1% of GDP rise. Similarly here also 0.1%, here 0.2%. Health has taken a 0.1% GDP increase. Agriculture plus R&D has taken a 0.2% GDP increase. This is for the first 8 months of this year. Similarly, real expenditure, nominal and real. What is the difference between nominal and real? Real is always adjusted for inflation. Okay. Suppose you are getting interest rate in FD of 8%, but inflation is 4%. So your net earning is only 4%. Okay, not 8%. So similarly here we are adjusting the real expenditure growth in the first 8 months. In education we are seeing 4.7 growth, for 7% growth. In the health we are seeing a 9% growth, and in the agricultural plus R&D we are seeing a 8.1% growth. Okay, so let's move ahead. Correlation between the India and world. We always say that India's economy is getting coupled with that of the world, or our economies are intermingling. So as I told you in the last lecture that India's long run potential GDP growth is about 8 to 10%, but India's actual growth in the short run will not only depend upon the internal conditions but also depend upon the global growth and demand. After all, India's exports of manufactured goods and services now constitute about 18% of GDP, up from 11% 10 years ago. So as the manufactured goods and services are mostly exported, so we need to consider the global demand too. Okay. So as we see, it is mentioned in the economic survey, in the period between 1991 and 2002, the correlation was 0.2 with the word. I will just tell you what is the meaning. But after 2002 till today, the correlation has doubled to 0.42, approximately doubled or more than doubled. And here what it means is, if the world's GDP decreases, GDP growth to be more precise, decreases by 1%, India's GDP decreases by 0.242%. That is today, if I am talking about. If I talk about 2002, if world GDP decreased by 1%, India's GDP decreased by 0.2%. Okay, so this shows that we are getting more coupled with the world's economy. So if world economy remains weak, India's growth also will face considerable downfall, and if world economy shoots up, India's growth also will shoot up. Okay, so in this example, if the world continues to grow at close to 3%, okay, rather than 4.5%, India's growth also will be 7 to 7.5% rather than 8 to 10%, which is its expected long-term growth which it can achieve. Okay, so let's move ahead. Future domestic consumption. How can we boost the future domestic consumption? It can be boosted by 7th pay commission. Obviously, when 7th pay commission is implemented, increased spending from higher wages and allowances of the government workers will start flowing through the economy as people spend more and more. Similarly, when we have normal monsoons, it will increase the agricultural income, and hence it will increase the gains for rural consumption, and most of the people are involved in agriculture in the rural areas. So and also for the previous 2 years there was drought. So when the right amount of rainfall occurs, there is more production and more income. Okay, but there are some downside risks, like less export. Before that, I would like to mention this sharp deterioration in the financial health of the metals companies, primarily steel companies, because everybody, or you already know that China was the main importer of steel, and it has slowed down. Okay, so steel has joined the ranks of companies which are under financial stress. Okay, so as a result of this financial stress, the proportion of corporate debt owed by stressed companies and their earnings are insufficient, so they are not able to repay their interest obligations. And those companies which were previously till December 2014, there were only 35% of the companies which were not able to repay their interest obligations. It has now till December 2015, it has increased to 41%. Okay, so that is another bad news for Indian economy, because its exports has stopped or decreased a lot. Similarly, there are other downside risks like increase in crude prices. We don't know, we are talking about the next year, and we don't know whether how will the oil exporters or oil prices will vary. This year we enjoyed a lot on the lower prices, and we have our oil companies have accumulated a lot of money because the less price was not transferred to the final consumers. Government decreased price for petroleum and diesel very less. Okay, if next year there is increase in crude prices, there can be a problem. Similarly, there can be combination of less exports also and increase in crude prices also. How? If there is increase in crude prices, there will be less money available to the companies which are dependent upon the crude to invest in some other revenues. It will produce more and produce less as well as export less. Therefore, this can happen when the uh, oil producers or oil exporting countries can decide that they will curb the supply which is presently available to a lower amount. So when the supply reduces and demand is constant but supply reduces, when supply reduces, obviously more people will crave for that thing and it will lead to rise in price in the international market. So let's move ahead to the next topic, that is startups. So recently Startup India, Stand Up India initiative was launched by the Prime Minister. So one part of economy that is witnesses unusual dynamism is startup sector. But mainly the startup sector is focused on the e-commerce as well as the financial services, not many other services, mainly e-commerce and financial services. So as of January 2016, the economic survey says that 19,400 technology enabled startups are in India, of which 5,000 have opened in the last year itself. This shows the entrepreneurial spirit of our youth. As of December 2015, we have 8 Indian startups that are valued more than $1 billion. This is called Unicorn Club, according to the economic survey. So no less than 2,000 of the startups have been backed by venture capitalists. Venture capitalists is those people who invest in various kind of new startups or businesses. So more than 2,000 of the startups have been funded by the venture capitalists, and out of that, I am talking about since 2010, 2,000 have been funded, and out of that 1,005 have been funded in 2015 alone. So this shows the interest in the Indian economy as well as trust in the startup sector by the foreign investors as well as domestic investors. So we also need to have an exit policy, because in India sometimes the companies take 25 years to exit. By the time everybody has lost their money as well as interest, so the exit should be fast enough that the people who can take their money out, they can spend in some other ventures or startups. And also in India, till now we have very less exit valuations, which are expected to increase when the SEBI's policies on listing comes. Listing means when their shares of a company are traded on a stock exchange. So when they get listed, its price can be decided by the markets. Okay, but currently it is in India there is very low valuation due to the gloomy global atmosphere. So startups have got a boost. Even startups have got a boost in the budget. Okay, so let's move ahead. Now other thing comes in, bit of geography into the economic survey. We see El Nino, La Nina, and forecast of 2017 agriculture. Now the 2015 El Nino has been continuing, and it is expected that it will continue till May 2016. And 2015 El Nino has been said to be same in strength as the 1997 El Nino, which led to depression in the production over the past year. And now the economic survey predicts or assumes that if there is a La Nina after the El Nino, there can be a much better harvest in 2016 and 17. So we have monsoons, very good monsoons in our area, Indian subcontinent. But when the temperature becomes high in the Peru region. There is less temperature in the Indian Ocean. So this leads to less temperature in the this leads to less rainfall in the Indian Ocean region. That is less monsoon. Less monsoon means less agricultural output, because still we don't have all the areas which are under agriculture covered by irrigation. Now it also says when it is followed by La Nina. La Nina acts as opposite to El Nino. La Nina is beneficial because it causes rain. And many a times the El Nino has been followed by La Nina. So economic survey says if La Nina happens, all will be good. Economic survey also compares the El Nino which happened in 1997 and 98. So the duration, that time also it was for 15 months, and this time also it is expected to be of 15 months duration. Now Oceanic Nino Index, what is this? It is the index which compares the East Central Pacific Ocean surface temperatures to the long-term average, and it is used by US National Oceanic and Atmospheric Administration, NOAA. Okay, so it is used by NOAA when there is consistently positive surface temperature of East Central Pacific Ocean surface East Central Pacific Ocean than the long-term average. Then it means there will be El Nino and depression of what? Depression of rainfall. It is happened in 1997-98 also, and this time also if we see between the November to January, there was 2.3 degree more temperature than the long-term average. It is talking about in East Pacific Ocean, that is Peru, Chile. Okay, so obviously the more rain will be happening there, not in India's side. That time also intensity was high, and this time also it is comparable to the 97-98 El Nino's intensity. So let's move ahead. Now economic survey says since 1950 there have been 22 El Ninos, and most of the El Ninos have been followed by La Nina. That is, out of 22, not most, you can say 9 El Ninos have been followed by La Nina. In La Nina there is abnormal cooling of sea surface water across the tropical west coast of South America. That is same Peru, Chile, they have low temperatures. So obviously the higher temperatures will be on India's side and more rainfall. So this phenomenon, that is the phenomenon of La Nina, have been observed in 14 such events since 1950s. That is, it includes immediately after El Nino also, and the La Ninas which are occurring naturally, not immediately after El Nino. That is, 9 La Nina events have happened after El Nino plus 5 which have happened independently of El Nino. Okay, so the meteorologists have predicted that there is 22% probability of La Nina happening just before the monsoon season of like June, July, August, September, and there is 50% probability of happening of La Nina in September, October, November. So that is, more probability is there after the half of the time of the monsoonal season have passed. Now the monsoon could also be enhanced due to favorable factors like positive Indian Ocean dipole. Now Indian Ocean dipole, in this the western tropical Indian Ocean waters near Africa becomes warmer relative to those around Indonesia or the eastern side, and especially it will be beneficial as we are suffering from droughts since the last 2 years. So this graph depicts what I have just told you by my mouth. In La Nina years we have the agriculture growth very high. See here, 8.4%. huge agricultural growth. In years other than El Nino and La Nina, that is normal years, where in which they are not disturbed by this atmospheric specialities, we have the agricultural growth as 3.7% of GDP. Now, in the periodic average, we find out it as 3%, that is average of this also and this also. But in the El Nino and this also, but in the El Nino years, we have a negative agricultural growth, that is our agricultural production depresses. So let's move ahead. What contingency arrangements we can make to avoid the bad impact of climate on our farmers? First of all, declare MSPs well before Kharif sowing operations. Incentivize farmers, like give them free electricity, water supply, fertilizers, etc., or farm loan waivers. But along with that, you should also tell them that you should not excessively use, like flood irrigation you should not use by pumping water more and more, thus wasting electricity as well as water, as well as causing the salting of their fields. Okay. Now it is also saying incentivize farmers to produce more crops which are prone to domestic supply pressures, such as pulses. You know, pulses prices 200 rupees per kg, because demand is more and it is not being produced as much as, and also MSP is not declared and these are not procured by the government agencies. So people or the farmers feel inhibited towards the pulses and they don't like to grow that. Similarly, we should timely contract the imports of sensitive commodities. So, for example, the onion. Always we listen that onions price has skyrocketed because of the hoarding. So we should already have ready-made contracts that as soon as the supply decreases, we can immediately import, thus curbing the huge hike in the prices of onions. Now coming to the very important topic, which is called twin balance sheet challenge. It is actually a challenge of public sector banks as well as some large corporate houses. Large corporate houses take debt from the public sector banks and are not able to pay later, leading to stress in the balance sheets both of the public sector banks as well as the large corporate houses who have taken the loans. So these loans are categorized as stressed assets or non-performing assets plus restructured assets, and these stressed assets have been rising over since 2010. So it creates stress for banks as they have very low capital, as they are not getting interest from corporates who have spent their money in the large projects, but demand has reduced, production has reduced. Also large infrastructure projects which are suffering problems of land acquisition, etc., etc. So as also the time of the Basel III norms comes over, that there should be adequate capital with the banks. So banks needs to have some reforms happen on their side. So first of all, what do you mean by restructuring? So when a company is having trouble making payment of debt, it will often consolidate and adjust the terms of a debt in a debt restructuring. Suppose a company restructures its operations or structure by cutting costs such as pay of the employees, also reducing its size through the sale of some of these assets. This is often seen as necessary when the current situation of the company may lead to its collapse. Similarly, in the case of banks, we have the same meaning. They restructure the accounts. Okay, that they sell some assets to the asset reconstruction companies, and they at some low price, and then asset reconstruction companies will have their own means for getting loans from the defaulters. Okay. So also due to these NPAs, banks have responded by limiting the flow of credit to the real economy so as to conserve its capital, because it is also required for Basel III as well as required to pay to the depositors. While investors have also responded by pushing down their bank valuations, especially over the past year. The shares of many banks now trade well below their book value because everybody knows that they have huge NPAs. Suppose the respected Malya ji, have just run out of our country, deceiving our government, and government is telling we don't know how he has ran away. So the large business houses that have borrowed heavily during the boom years to invest in infrastructure, like Malyaji have invested in Kingfisher, and also the commodity related businesses such as steel, their profit have reduced and debts are rising. So the most of the firms are cutting their investment so that they can preserve their cash flow, because cash flow is very much required in business to buy the raw materials, pay salaries, etc. So let's move ahead to the next slide. Some steps taken by the government is the Indradhanush scheme. This is the scheme of comprehensive bank reforms in which there was a provision of how to appoint the MDs of the banks, how the bank board bureau will be formed, how the NPAs will be restructured, how the accountability of the banks can be improved. There was also a 5/25 scheme given by RBI. Now what is this 5/25 scheme? Now we see during the last decades, commercial banks have become the primary source of long-term debt financing to projects in infrastructure and core industries. Now infrastructure core industry projects are characterized by long gestation periods like 20 to 25 years and very large capital investments. So the long maturity of such project loans consists of an initial construction period, okay, like 1 year it takes in construction, and there are also there is also a concessional period in which nobody charges a loan. That is a kind of break-even period, and then then the repayment period starts. So banks get the money only for 10 to 12 years out of 25 years. To make it more clear, I will tell you that the banks get FDs. Most of the bank's savings are in the form of FDs. These FDs have a repayment date or maturity date of 3 to 5 years. Most FDs. Okay. So if the banks give money for 20 to 25 years long term project, and if at that time the money is not paid by the infrastructure project borrowers, okay, what will happen? Banks will not be able to pay to their depositors. Okay, this is the problem. So banks have told that they are not able to provide such long-term financing owing to asset liability mismatch. That I've just told you is the example of asset liability mismatch. That is assets FD. Assets, the loans that they have provided, they are not getting back, and liability which they have to pay to the depositors, they don't have money to pay for that. So this causes a mismatch. So to overcome this mismatch, they invariably restrict their finances to the infrastructure companies to the maximum period of 12 to 15 years. So after factoring the initial construction period and repayment moratorium, the repayment of the bank loan is compressed to a short period of 10 to 12 years. like 3-4 years have gone in moratorium as well as construction. So 10 to 12 years, when the project of infrastructure project comes into operation, they can charge their loans. But it also constrains the ability of promoters or the people who are leading those projects to generate fresh equity out of internal generation for further investment. So as a result, they levy higher user charges, which have its own problems, like toll tax they charge. In some places they they take 120 rupees as toll tax. This is because of this reason. So as a result of these factors, some of the long-term projects have been experiencing problem in servicing their loans. So banks gave a view that to fix this problem, what they can do is periodic refinancing of the projects every 5 years. Okay. So what will be the advantage of that? This will ensure long-term viability of infrastructure projects, because it will smoothen the cash flow as repeated infusement of cash will be there. This would also help in extended finance to such projects without getting adversely impacted by asset liability mismatch issues that I've just told. The need of restructuring would be minimized by the banks, as banks can give money periodically, so it can take account of the cash flows they have. Okay, understood. So resolving this twin balance sheet challenge requires 4 R's. What are these 4 R's? First of all, this strategic debt restructuring. The basic thing is strategic debt restructuring is that banks takes the control of the promoters. That is, it can change the management team. It can throw out the promoters. It can install some other promoters. It can even take the shares of equity of the promoters and put it in the project. Okay, so this is the strategic debt restructuring. Now, for resolving that twin balance sheet challenge, the economic survey says it requires 4 R's: recognition, recapitalization, resolution, and reforms. What do you mean by recognition? That is, banks must value their assets as far as possible close to the true value. Okay, once they estimate that what is the value of their asset, their capital position must be safeguarded by infusion of equity. That is, recapitalization means we put more and more equity and reduce the debts. The bonds in the form debt in the form of bonds. When we have more equity, there will be less risk because they don't have to repay. So the risk is of the person who buys the equity. The third thing is resolution. Resolution is the stressed assets in the corporate sectors must be sold and rehabilitated as the government desires. The next thing is reform. Future incentives for the private sector and corporates must be set right to avoid a repetition of the problem as everybody has been shouting. Okay, so these 4 things need to be done for reducing these stressed assets. Now, one thing to note as given in the economic survey is that recognition will estimate the value of the assets that banks have. Now, after the recognition, what are the resources that can be used to recapitalize the banks? So the resources can come from the selling of the non-financial companies by GOA. GEO has opened many non-financial companies. It has been recommended by many economists that it should sell off these companies and put this equity in the banks which are stressed. But other new suggestion as given by economic survey is that RBI can sell off its excessive capital buffer. As you can see here, total equity percent of balance sheet of major central banks of different countries. You see, only Norway exceeds RBI in the total equity which has been kept by RBI for earnings and contingencies, some emergency. But you can see many countries like Euro area, also the USA, have very less total equity. Okay, and RBI has approximately 31 to 32% equity, which it can slash it down. Okay, to and this equity that it slashes down, it should be put in the banks. Okay, so if RBI were to move even to the median of the sample, suppose 16%, I have already told you that it is 13% is big with RBI. If it moves to the 16%, it will free up a huge amount to capital to be deployed for recapitalize the public sector banks. It should be initiated jointly by the RBI and government, and redeployment of capital must not compromise the independence, integrity and financial soundness of the RBI. RBI should not be compromised for the public sector banks. So once these resources are there, after the recognition are identified, the remaining 2 R's. What are the remaining 2 R's? Is resolution and reform can be pursued, and these can be pursued by creating bad banks. Now what are these bad banks? A bad bank is a bank set up to buy the bad loans of a bank with significant NPAs at market prices. So by transferring the bad assets of an institution to a bad bank, the banks clear their balance sheets of toxic assets, that is NPAs, but would be forced to take write-downs. Write-downs means it will be forced to reduce their value in the market, that is market value as we say of a company. So banks that become insolvent as a result of the process can be recapitalized, nationalized and liquidated. So these bad banks will become a separate institution from the bank, and banks can again give away the loans to the corporates. So I have taken the second part. I will continue the third part of the first chapter, as this chapter is very long. So please stay with us. Please like, comment and subscribe to our website, and please like our Facebook page. Thank you everyone.